Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. I'm Paul Winkler, joined here this hour with Mr. Jim Wood. Good to see you.
Good to be here.
Good to be seen.
Yeah, there you go.
All right, there you go. All right. Yes, so we're going to get into, I want to back up just a little bit. When, I don't know about you, Jim, but when I have looked back over the years and just big things that have happened with clients and helping clients, and the biggest thing really is trying to help with behavior is a huge deal. Really we kind of often major in the minors as far as, what investment companies tend to focus people on. They tend to focus them on, well, number one, things that are like what's the management fee on this fund versus the other? Important, no question about it. But by far the biggest management fee of anything is just behavior, is how we approach investing. And, the difference in returns historically, according to the research that has been done on, there's a lot of different research that has been done on this. One study shows it to be, like the average investor in asset allocation funds makes about the return of the inflation rate, which is just pathetically bad, versus markets at like large U.S. stocks at 10 historically is the long-term return of that, and we're talking about like 3% versus, 10 and, in asset allocation investing being somewhere in the neighborhood of 7-8%, depending on the asset mix. But in essence, the difference in return is really driven by behavior. And so much of behavior is driven by sales. Because you think about it, where do people actually get information about investing? They get it from people that are selling things. And this has been the idea on this show. As a matter of fact, I was talking to somebody at the radio station this week, and they were talking about, hey, Paul, have you ever thought about doing a market update on the station? Talking about what's going on in the market, what's going to be happening in the day ahead. And I said, no, that's I said, this is the antithesis of what we stand for. Because market updates do nothing but cause people great distress and anxiety and cause them to do really dumb things with their money.
Well, I've actually joked about that with clients in the past, that when we're talking about how that would work. Mm-hmm. And I would just say, well, it'd be boring because I'd be saying the same thing every day. Global diversification, long-term, right, appropriate risk, I'd be, and all that, instead of, well, the Fed's going to make this and we got to do this decision, or, interest rates are going up and we got to change and move things around. And instead, the daily update, we could just, record it once and then play the same thing every day.
Well, and then, the update on the market is going to be exciting. It's going to be, hey, maybe I can protect myself, is really why people are so drawn to it. Because, I'm worried about what's going to happen in the future. Well, how do I protect myself from what's going to happen in the future? Well, I try to make a prediction about what's going to happen in the future. Or if I find somebody that can help me with that prediction, then I could make a move and protect myself. But what do we know? We know professional managers, if you're looking at large U.S. stocks, 93% of them can't get what markets have done. They can't get returns that are as high as that. That's pathetic. When we look at, small companies, it's 97%. And it's not because they're stupid. It's because they're trying to do something it's an unattainable goal, predicting the future and protecting oneself from downside risk and making sure that I'm there when markets go up. So what happens is that people are getting information from people that are trying to do something that is impossible. And when you hear a firm talking about, hey, here's the market update for the day, or watching a TV show and they're telling you what the market's doing at any given point in time, recognize that is the biggest reason investors fail. Why is it, so often we hear about people that invest in real estate doing okay? Now, the reality of it, it's a job, and that's not something that, for a lot of people, that doesn't make a whole lot of sense. And those of you that have done real estate investing go, I don't want to mess with that. I'm not using it as hey, you ought to do this instead. For some people, it's okay to have that job. I don't personally like it. But here's the thing that I like to make a point on, is so often people end with some modicum of a success with real estate investing because they're not getting a day-to-day, second-by-second update on the value of the properties that they own. And it's not that easy to sell the property that you own and buy another one to replace it. There's a lot of friction, the commissions between the buy and sell price and things like that, and the expenses and the hassle and trying to find a buyer. Whereas stock market is a lot easier market to do that with. You can buy and sell and trade and do that all day long sitting in your living room in your underwear.
And the real estate market, too, they're not bombarded 24/7 with a ticker across the every time you turn on the TV or the computer or anything like that,
Right.
or media just with their various scare stories or, this is how you get rich or you better run for the hills, all that stuff that day to day you get with the stock market. With real estate, to your point, is you just don't get that bombardment. So
Right. So it doesn't tempt you. You don't have that emotional, psychological temptation to do something that's actually really, really bad. Because the problem with market time is you got to be right twice, as we always say. You got to be right when you get out, then you got to be right when you get back in. And you don't know what the news is going to be because the news is what drives the stock market. And if people get that it's the news driving the stock market, now we go, oh gosh, we're trying to do something you can't do. But that's, you look at the investment industry, and like I said, it's not just investment advisory firms, mutual fund companies. You look at the average buying and selling, the turnover rates inside of funds. You see the tactical asset allocation. They'll say, "Hell, we don't time the market." No, we don't do that. Read their ADV. Which is their disclosure required by the government. That's what I crack up when I hear people say, we don't try. No, we definitely know you can't time the market. And I'll go, well, why does your ADV say that you're going to try? Why does it actually say that you are going to try this? If you don't do it, if you're not, why does it say that you use tactical asset allocation? Why does it say that you use, top-down investing or bottom-up investing or those types of strategies to price stocks and determine the proper valuation on them? Why does it say that if you don't do that? And that is what's so. Do I sound frustrated? Do I need some help here, Jim?
We see a lot of this stuff.
Yeah.
One thing in terms of when you saying right twice, and people get out when they get scared, right? And you get those calls and it's like, hey, what should I do? Should I get out of the market and everything? Well, if people do that, to your point, they have to get back in at a better time. But the question that people never think of is, okay, I'm going to get back in when things look better. But by the time things look better, I mean, at what point aren't you going to be scared anymore? Because if the market keeps going down and down and down,
when the news is good,
yeah.
And when's the news good?
Right.
After the market goes up.
It's made back up way past where you got out.
Right, exactly.
Yeah, and
it's like that, Jim, is like that Business Week, headline that we use in the very first workshop. And it talks about, how the future's looking decent. What was it? It was reasons for optimism. Wasn't it something like that? Do you remember?
That phrase I remember.
It's something like that, that there's reasons for optimism. And the point we like to make is that most of the market upturn that occurred in 2009 occurred before that headline came out and that front cover of Business Week was there.
Right. And then there's in that same point, the guy from NASDAQ that just said all the smart money wasn't invested, right? Because it started going up in March, and the smart money wasn't, we're avoiding this part.
It was the CEO of the New York Stock Exchange.
Okay.
Is what you're talking about. Yeah. It was like, you're right. I mean, this guy goes, the smart money's waiting for another market upturn around June or July. Well, wait a minute. All the market upturn to happen in March, April and May. And he's waiting for what? Yeah,
and so all the smart money missed about a 25% upturn in large U.S., about a 50% upturn in small.
Yeah, it was huge. So and that's just the point. And where people get information about investing is somebody that's typically trying to do these types of things, but giving lip service that they're not. So this is why I think it's so important, not for you to know everything, but just get engaged enough to know how things are being done and making sure that investments are being chosen, not based on criteria that is impossible. Trying to pick stocks and figure out which ones are going to be better than others or time the market or anything like that. But, asset mix. asset, the allocation, the different areas of the market. And so often, this is something I've been talking about a lot lately but the average investor doesn't have very much money in areas of the market that have the long-term highest expected returns and can reduce the risk of the portfolio. Why not? Because they're not familiar with them. Why are they not familiar with them? Because what do you hear about the market every day? What the Dow did, the S&P 500, and the NASDAQ, large U.S. stocks, large U.S. stocks, large U.S. stocks. So that's all you typically hear about. So that's a big problem. Now, the other thing is that market, if you look at market volatility and go, oh my goodness, this is kind of scary, market volatility, ups and downs, and recognize that once market downturns occur, people will come out of the woodworks. Oh, the market's going to go through a really bad stretch, and markets tanking on news on this or whatever. You'll hear that type of thing. And like I said, you got to be right twice. You needed to be right before that news came out, number one. But here's the thing to remember. Market downturns of, like, let's say if we look at the S&P 500, of 5% moves, intra-year moves, happen on average 3 times per year since the 1950s. 3 times per year. Once a year, 10% downturns intra-year. So you can think about, the assets that you've got. You've got a $100,000 portfolio and it drops down to 90 and you're going, oh my goodness. That happens on average about once a year. $5,000 drops in my example based on my number happen about 3 times every single year. So when that happens, I just look at it and go, oh yeah, that's what happens. It's normal. And if I normalize that, it's not so scary anymore.
And to take those numbers even further, if you go out to every 5 years, you get a drop of over 20%, a true bear market, and the average of those has been 33%. And so these things are going to happen, and if you expect them, they're a lot easier to deal with because it's that when you're surprised by them and then like, I never thought my $100,000 could be 80 before it was going to turn into 150. I mean, then that's when people get scared, and then they start making those bad decisions, running for the exits at the worst possible time.
Yeah, no question. And we like to use the example of marriages. If I thought every single day would be bliss and everything would be great, you look at the divorce rate, it'd be even higher, and some people do. They go into it thinking every day is going to be blissful, but that is the reality of it. Life goes through cycles. Everything goes through. You have good days, you have bad days. Quite frankly, it's interesting because a lot of times kids, and me and my psychology, I love talking about this stuff. But if you look at younger people, and you go, wow, there's this high depression rate with younger people, and so on and so forth. And some of the researchers actually out there say that a big problem and big reason that the depression rate and the anxiety rate is so high is because kids expect to not ever feel bad. They expect to not ever have difficult days. So when they have them, it gets blown out of proportion. And that's the same thing with the stock market. So I think there's a lesson to be learned, not only in life, but there's, you look at the markets and then you go, well, so how do we deal with market volatility? Well, that's why we want to have diversification in fixed income investments, especially as you get older. As you get older, you want to have the types of I was looking at a portfolio yesterday, and somebody had actually brought it in, and the portfolio was a huge 401k plan, a huge employer in the Middle Tennessee area, really big. And what I was looking at in the portfolio is some of the holdings, the bond holdings, high yield bonds. I mean, good grief. You've got companies with one foot on a banana peel and the other in a bankruptcy court borrowing money. They are going to be the ones that have financial trouble when stock markets get bad. And that's your safety part of your portfolio. That's the risk-free or risk-reduced part of your portfolio. That's really bad.
Yeah, and that stuff can certainly blow up. We have the example that we used in that workshop mentioned earlier, where there was one particular fund that was held widely in some 529 plans and some college accounts, that when the 2008 whole debacle hit, this bond fund that people were thinking, okay, I own bonds, they're pretty conservative. This bond fund lost 80%.
Yeah, it's horrible. So, just recognizing that is a mistake that's made, and it's not made by a novice investor. This is made by a major corporation for their 401k. Now, what do you do in that particular case? In those cases, what we do with our clients is you're going to have other investments. They don't have to be managing the portfolio in there. And that's, where you have these funds that are designed for you retiring in particular years, or in this particular case, you'll have how many years to retirement is the way the fund was named. But that is a mistake that we see often with people. But recognizing that where do we get information about investing is huge. And many times, the 401k, the provider, the employer, where are they getting information? Because sometimes what we do is we have this false sense of confidence that my employer has hired the best investment manager that they possibly can. And they probably did based on what they knew. I mean, think about, one of the largest pensions in the world. Largest, big, huge amounts of money. And for how many decades did they use an investment management style that did nothing but disappoint? CalPERS, California Public Pension. And what happened is they finally fired everybody and started doing what we've been teaching here for years. And that is, that this stuff, you've got to get this, because what happens is so many people, their pensions were dependent upon this. And, then they go back and forth, and then the emotions cause them to go back into, it's just like like the dog going back to what he ate for dinner yesterday. And it's just like, oh, why do we go back to that? Because our instincts and emotions, and because why does the investment industry do it? Because it sells. It's what people think that they want.